Let's start talking a little bit about the trading plan. I try to keep this very simple for traders because it's easy to remember how we're trying to approach the market. I'm not going to be writing out a comprehensive manifesto here. These are just some important tenets to remember for when you go and try and apply this going forward. Our goals are to trade between 10 a.m. and 2 p.m. Eastern mostly. That does not mean you can't trade the opening 30 minutes. I just don't recommend it. It doesn't mean you can't trade the last 2 hours of the day. Again, I'm a little hesitant, particularly towards the end of the day, unless I'm already in a position to be entering new trades. 10 a.m. to noon is our kind of sweet spot for entry. That lets the VWAP develop enough to give us signals, but it's not so late in the day that a lot of the kind of high volume move has already occurred. We predominantly trade large cap securities. You guys have heard me say this before, because they tend to react better to the volume weighted average price than something like more momentum names. I have looked at this a bit. There are momentum trading stocks that to which a VWAP applies. I think the problem is that you tend to end up with these emotional scenarios, high volume, a lot of volatility, usually fundamental, some FDA release or acquisition or takeover, or they became a blockchain company or whatever. Those don't seem to abide by VWAP nearly as much as a large or mega cap stock that's simply trading technically on average or higher than average volume. My goal is to trade repeatable patterns, which I can get better and better at trading over time, rather than a unique scenario each day. So that's why we don't focus on a different momentum stock every day. Our goal tends to be 2-to-1 risk reward or higher. Should be very straightforward. I think anyone who's ever heard of the concept of a risk reward ratio understands why you'd want it to be asymmetric and favorable, but I maintain that it's got to be 2-to-1 or better. I've certainly had much higher risk reward on trades, particularly trend trades, obviously, that go quite favorably in my direction. But that doesn't mean we plan for that or try to account for that in advance, because we don't always know how long a trade's going to take to develop or to actually materialize, or when it's going to materialize, if it's going to spend most of the day building and then run up at the end of the day, or if it's going to quickly move in the morning and then stabilize. When I say 2-to-1 risk reward, that relates back to what you probably heard me say before about my typical stop placement. Typically on these trades, I'm giving it between 1/4 and 1/2 deviation of risk beneath the support level against which I'm structuring the trade. So let's use two very simple examples. Oops, that is not a flat line. Let's try that again. One from this type 1 long on SO. It had consolidated near the top half of the prior day's range and was threatening to break out over that prior high. It got above the volume weighted average price, had a nice strong slope building to it, even early in the morning. And notice that the most we'd need to give it in terms of a risk level, and again, we can zoom in and really measure this, but I think you guys can see the actual net amount of money risked is 10 cents, maybe less, relative to an entry just above the volume weighted average price and a stop about 1/2 deviation below the volume weighted average price. Part of the reason I'm willing to give it 1/2 deviation is we're early in the morning, right around 10 o'clock. The deviation bands have not expanded yet. We haven't really picked much of a direction. So even though 1/2 deviation sounds like a lot of risk, as I said, we're talking 10 cents net of risk here. Even on a pretty sizable position, that's, you're not risking that much. You're risking $100, 1,000 shares, right? Later in the day, as we get a type 2, so again, we'll kind of get the same color coding here. Let's assume that our entry comes a little after we've observed some confirmation or respect of the deviation band. So notice I'm not trying to anticipate these trades. I'm waiting for some other trader to defend it or bounce it at the VWAP or the DEV band. Where would our stop go? You might think I'm going to give it all the way down to a half deviation relative to that latest low and the kind of support we observed here. But think about how far a half deviation is now that the dev bands have expanded. And look at how closely that low respected the deviation band itself. We could probably get away with a quarter deviation stop that slowly trails up as the trade works in our favor. So we're really only giving it a tiny amount of range on the other side of that deviation band, what we kind of call a tolerance zone or a tolerance band. You might remember actually in the intraday VWAP study, there's an option called tolerance band width. You can go in and type in 0.25. And voila, we can actually see the amount of deviation, can't believe I just said that, the amount of wiggle room around a deviation, the amount of tolerance, as the name implies, that we might be willing to give this trade so that we don't get shaken out by it, even if it doesn't pristinely or perfectly respect the deviation band. Can you see why giving these trades a little bit of sponginess, a little bit of wiggle room is really essential in order to stay in a particularly strong trade throughout the remainder of the day? You know, notice we also couldn't possibly have known that this is going to be as strong of a breakout, particularly in the second half of the day, until we had observed the support occurring at or near the deviation band itself, right? We wouldn't have known necessarily it's going to stay in the fast lane. We could have suspected that. And it was a decent multi-day breakout over, like I said, prior highs, decent slope to the VWAP. We got in the fast lane, but again, no guarantee of holding. So we couldn't have necessarily known, well, I'm going to take 10 cents of risk and I'm going to make $1.50 on the upside. It's not that we can necessarily target that in advance, but that's the nature of trying to stay with a trending trade and allowing it to develop over time, rather than being a little more selective, that's not the right word, a little more picky with your exits for a counter trend trade. Obviously, this is of the trend variety. You guys remember me talking about the two different styles, either magnetic attraction or magnetic repulsion. It's pretty clear here. We've got a strongly trending VWAP. We have picked one side of the VWAP, and we are in fact finding support or containment, as I called it, to the outside. All right, so this meets all the criteria for a strong trend. When would you exit this trade? Someone asks. I gotta be honest, just knowing how I would feel at the end of the day up in here, in the event, I don't want to give myself too much credit here, in the event that I had held up until this point when we break even higher out of that flag, at that point it looks like, wow, it is really respecting the dev band so many times. It's worth it to stick it out nearer to the close. But I gotta be honest, seeing it make a weak higher high and then pulling back, I have a feeling I probably would have exited somewhere on this pullback. I don't think I would have held it or held it overnight. And that's assuming I held it into the second half here. You know, another neat thing to do, I've actually got this pre-loaded here. This is a comparison study. I've set it to be candles instead of bars, and I've set it to compare to the SPY. So that allows us to see kind of overlapping, overlapping comparison of what the broad market did throughout the day. So if we match these up, here I'll try and match the scaling even too, just so we get a kind of apples to apples look and feel to it. You can see that what SPY did versus what this stock did separated dramatically at around mid-morning, right? SPY started going sideways, digesting, consolidating. So something like this, which is showing significant relative strength, I think deserves to be held or at least tolerated more than a stock that's maybe bucking the trend of the market in the wrong direction, if that makes sense. You know, our goal is only to hold these trades for between 30 minutes and 3 hours. So it's not necessary that we have to hang on to these trades for the entirety of the day. And these kind of all day unidirectional trades are fairly rare. You know, seeing the market kind of wane and flatten out, it's very possible that I would have gotten spooked around here too. I'm just acknowledging that because I know I'm human. I still make plenty of faults in my trading. It's very possible that that consolidation and the market kind of waning would have made me more cautious. Although, remember what we were kind of mentioning before is taking a partial element of the trade off, maybe taking a half or a third of the trade off to lock in some profits, and saying to yourself, look, I'm either going to make a little bit of money and stop out on the rest at break even, or I'm going to, you know, really nicely hang on to 2/3 or half this position for as long as I possibly can. I think having seen that survival at the deviation band on decent volume, middle of the day, and bucking the trend of the market in a very positive, bullish fashion, yeah. You know, I get a lot of questions about trading frequency or your kind of trade style, differentiating between swing trading, intraday trading, or even practice trading. For a swing trader, for somebody who's looking to trade predominantly multi-day VWAP, I'd probably be evaluating somewhere between 20 to 50 setups per week. So, you know, that's really only a couple trades per day that you're really deeply evaluating or applying multi-day VWAP to. I'd probably be taking, you know, 2 to 5 trades a week. Again, they really need to look pretty good, especially if you're trading on a multi-day VWAP basis, if you're not around to manage them. If you're an intraday trader, by contrast, I'd probably be looking at 20 to 50 setups per day and taking 5 to 10 or 15, depending on your activity level, trades per day. A pretty active day for me would be, yeah, 15 trades, round trip. If I were, okay, and then here's an interesting one. If I were practice trading, so for all the developing traders out there, for you, it's really about building repetition. You want to see many setups and evaluate many trades per day to build that framework in your mind. So I'd be trying to go through 100+ charts per day. And especially if you are practice trading, your job is not to grow the account or to quote unquote be profitable. Your job is to build experience. Your job is to take many trades per day, regardless of the outcome, to build your experience with what did I think was going to happen, what did end up happening, and how did I manage it? How could I manage it better? Some traders ask me, can you trade only counter trend or only trend? So going back to the 4 primary trade types, you guys may remember trade type 1 and trade type 2 are both trend trade types. Trade type 3 and trade type 4 are counter trend trade types. Can you only trade one group or the other? You certainly can. I think the problem is that it requires so much discipline to be able to only look for one type of chart, even when the broad market is doing something completely different. If the market is breaking out, you're going to have a very difficult time if you're a counter trend trader. And I think it might be tempting to try to trade trend during those environments. I would try and develop both. I understand needing to focus on one or develop expertise in one before the other, but don't lull yourself into a false sense of security by either saying counter trend trades are very common and therefore I'll be able to trade frequently. Well, that's true. You're going to get left in the dust when it's a trend day. And by contrast, if you are a predominantly trend trader, you're going to be very bored 70% of the days when it's typically kind of chop, consolidation, sideways behavior. You absolutely need both. It's like learning to drive and only learning how to turn right. You know, could you theoretically drive a car that way? I mean, I guess, yeah, it would be insane. But, you know, it's a lot more helpful when you know how to maneuver the car in both directions, right? Another bullet point I've written down here, the goal is to participate rather than to drive the market. Let trades develop rather than trying to create, conjure, or manufacture them. The best trades are the ones where you have to do very little. Your effort level is very low because you've positioned yourself in the right direction and style aligning with the market. Large cap securities are more reactive to VWAP because they're more likely to be institutionally controlled. Kind of what I've found is that momentum stocks can have some institutions behind them. There's a lot more emotional trading happening there rather than kind of forensic, scientific, share by share analysis trying to get the best available price. It's a lot more of just catch the momentum, get the direction right, try and make a few bucks. Large cap stocks tend to abide by VWAP more because the people trading them are trading hundreds, millions, hundreds of thousands, millions, or billions of dollars worth of stock. And therefore, every entry really matters to them. There are also enough large cap securities that if you as a pattern trader are really looking for one decisive pattern, one particular pattern, you're going to be able to find it because there are enough data points, there are enough stocks out there that you can literally go find the examples of that pattern rather than, and not to knock futures trading, but let's say you're a futures trader, you've really only got 6 or 8 major contracts that you probably watch, if that. And there's only 35 in total. So your data points are quite limited in terms of finding something that's abiding by VWAP or behaving the way you'd want it to in order to take one of the 4 example trade types. I found that if you limit your trades to a discrete or finite set or number of trades, you will dramatically improve as a trader. It's like trying to hit every type of pitch versus becoming really good at hitting fastballs. If you limit what you're looking for to only a finite set of trades and then seek out those trades, you're going to build repetition and familiarity with those trades over and over again. So that's the other beauty of trading large cap stocks. You're not trading a unique circumstance every single day. You're trading the same circumstance basically on just a different chart. You might have traded Apple yesterday and Microsoft today, but they're all basically, you're trading the same thing. You're trading VWAP and price's reaction to itself rather than whatever is moving or whatever is hot today. So I want to ignore the first half hour, the first 30 minutes of the US market open. I've never really found great success trading in that crazy, chaotic time when people are throwing shares back and forth. VWAP isn't properly established at that point in time. Like, we don't have enough data to really even derive an actual average. I mean, we do, it's a very young average. It's a very, new average. So I tend to wait until about 10 o'clock Eastern to start trading. 10 to 12 Eastern is my prime time. That's when I tend to find a majority of my trades. So not the first 30 minutes, but the next 2 hours of the US market. In the middle of the day, I am still finding some trades. However, I'm shifting more to managing my winning trades and letting the losers naturally stop themselves out. The last hour, half hour, I also don't trade. And again, just, if you're forced into trading that last half hour, you're probably not in a good trade, right? Otherwise, you're just letting your winning trades continue winning. You're going to close them out at the end of the day, or you're going to hold them overnight. So yeah, ideal trading time is 10 to 12 Eastern. I really do call that my prime time hours because that's when a majority of setups occur. The risk I've experienced with doing prep work is you end up scripting in your mind what you expect to happen. It's probably better to have one of 3 scenarios roughly gamed out for a stock that you're making a plan on: up, down, and sideways. If it's going to go up, it will likely do these things. If it's going to go down, it will likely do these things, etc. As far as trying to find which stocks have catalysts, the problem with that then also comes in high volume stocks particularly. The problem is that if you get high volume because of emotionality, meaning there's some intense news event or press release, or the CFO was arrested for accounting fraud or whatever, some catalyst, people might be reacting emotionally to that and not as concerned with abiding by the best principles of VWAP for the day. So an ideal scenario would be something that's experiencing higher than normal volume, but not massive volume. Massive volume typically relates to emotionality, whereas higher than normal volume means extra institutional interest in a given day. You know, I gotta be honest, I really don't. I am a chart purist. I'm somebody who wants to read the chart. I've always found that if, let's say there's an unexpected industrial report and there's more supply than expected, so the price is going down, you're going to see every stock in that sector have a downward drift because of it. So do you really need to know the reason for it, or do you just need to directionally assess, how to trade that sector? I know it sounds overly simplistic, but right?